If you're an ambitious care provider, the likelihood is that at some point you're going to need to explore some type of debt finance options. But since COVID, the funding landscape appears to have changed dramatically and seems to be in a state of flux. To get some answers around how things have changed and what options are available to care providers, I invited Scott Murcott onto the podcast. Scott's one of the directors at Montane Finance, has been in the care sector, working in the finance arena for many years. So in this episode, he does a brilliant job of laying out the current state of play for care providers looking for funding options. I'm Simon Parker, and this is the Care Leaders Network podcast. So here goes, debt finance in 2023, what you need to know. So Scott, finance with the care sector has changed dramatically through COVID. What can the sector expect in 2023?
Yeah, absolutely. I think from what we've seen post-COVID, there's been a reluctance from the high street to really look at new lending. I think there's lots of reasons for that merit that, warrant that. Ultimately, they have existing books, that existing connections of clients that they have to look after, and that's been their prerequisite, which we totally understand. I think the interesting thing is it's left a gap in the market, and that gap has been, I suppose, successfully exploited by the rise of, or the increase in the challenger lender. And that's been really interesting piece that we've seen, whether it be challenger lenders who've grown, or albeit we've seen new lenders into the sector as well. But it's a fascinating move, and I think that's something that we'll continue to see. Yes, the high street will return, but I think what the likelihood is that will be in a guise which is slightly more conservative in their approach, a more vanilla lending, if you like.
Got you. No, that makes sense. I mean, I've heard all sorts of new lenders basically coming out of the woodwork. These challenger banks who are looking to maybe be a bit more creative than the high street lenders as well. And I think for people involved in M&A activity, where maybe the deal's a little bit left of centre, or it kind of needs a particularly creative approach. This is where these more creative lenders can get involved, the challenger banks, etc. So give me like a bit of a summary, kind of what was happening during COVID and afterwards from a lending perspective, to kind of put into context maybe the landscape as we see it today.
Yeah, I think, as I say, you look at the lending full stop, that it's almost on record. We just haven't seen anything like this before. And within the care space, it's been impacted like never before. It's really shown how resilient the sector is, that we're in a position where we are now, where we are seeing the market looking positive. But from that position, you've got banks, high street banks saying we're just stopping lending. We will support our existing clients, but you've got full teams of a national print of BDM, of business development managers. You've got targets for them to hit. I heard a really interesting chat with the head of healthcare for a high street bank, who said just on their loan book, for their yearly target, it was achieved within 2 days of lending support to their existing book. Now that should incorporate business development, that should incorporate new lending, but they were able to achieve that within 2 days, just within their existing book, when that was for supporting clients. So I think from the position we are now, it really is a credit to everyone involved in the sector that we have been able to come out of it, and it's highlighted how resilient the sector is, that new lending is available now, and as I say, albeit with a slightly more conservative sort of guise, but it is there. And that reluctance to lend, as I said, has given birth to different options, and those different options now, the bandwidth, it may be in terms of the loan to value, in terms of the type of asset that we can look at. It might be the amortization profile, so how long the bank can lend the money over, but it really is a completely different landscape to pre-COVID. And I suppose being able to navigate that is so important. I think that it's now more than ever, operators need to look at it in a more holistic, maybe open-minded approach, because the reality is, gone are the days where you've got a bank manager who, one, is going to be present for the next 20 years or throughout your journey as an operator, but also is going to have the capacity and credibility to deliver what you need, whether that is a parcel of land or whether that is, an acquisition, refinance, etc. So it's completely changed the landscape.
So we've obviously talked about the difference between the approaches being taken by the challenger banks and that of the high street. Talk to me about the providers, maybe different operators entering the sector, people looking to do refinances, consolidation, growth, that type of stuff. Give me an overview on kind of what's happening in the on the landscape in that regard.
Yeah, so I think, to echo your sentiment, in short, the answer would be yes, but attached to that is the caveat, read the small print. And I think that is so important because the key and the reason that we've seen such a strong bounce back is and it's so resilient, the sector is so resilient, is because of the caliber of operator that we have, because of the dedication, the commitment, and the track record that we have within this space in terms of operational. So the banks are really looking to scrutinize and support the right operator. They're looking to harness that management in situ. So, whether that's a refinance or an acquisition, the key really is looking to say, is this an operator that has that we want to back moving forward? How have they handled COVID, and the tools that they've got to help them to push forward? And I think if it is somebody that they want a team that they want to support, a lot of the other bits will fall into place. So the other bits might be, let's say it's a refinance. If it's the right management team, they will look at the types of asset class that you've got. What type of home is it, the size of it. It will also look at the rating on the home. Ideally, we'll look at the good as a minimum. If there is a requires improvement within the group, it's not a catastrophe, but I think the majority of the group needs to be good for us to obtain it. The rates and terms from the lender that aspiration will be after. Then moving forward, if you're looking at acquisition, very similar, but rather than it just scrutinizing the existing group, we then also have to look at the target. So again, how well is the home? How well is the home performing? What is the level of CQC within the home, etc., etc. What's key with this position, and this will move on to the next point, which is what you said about the new entrant. The level and quality of the management team will dictate the caliber of the rate moving forward. So, ideally, most operators will be looking to take something that's underperforming and to turn it around, add value. But to enable to do that, they have to have the credibility for the bank to say, we can see a brand, we can see a quality of care in your existing group that we trust, so we'll do that. Whereas for the less experienced operator, there's going to be more scrutiny on the target. So the bank would want you to be buying something that already has the management team in place, that already has the track record, that already has the profits. So it's a real balance. But ultimately, the stronger the operator, then the more bandwidth we've got to look at the type of target. And then when we come on to the last point, which you said, which is a new entrant, it is very difficult to enter the sector. And it is going to be a lender that we need to be more holistic, probably more open-minded about the type of deal, and it being more a case of success in finding a lender and obtaining funds rather than getting you a market-leading rate. It will be a case of, and it's, the key I would say right now is managing expectations, managing expectations of the operator to ensure that, it's fit for purpose. But to enter the sector, it is possible, but very, very difficult. And the key is, is the home performing well? Is there a management team in place? And can they harness that existing track record in the target to support a new entrant coming into it?
I guess all of the stars need to align, particularly for new entrants to the market. And given everything that's been going on within social care recently, I guess the levels of scrutiny from credit teams are just going to go up as a result of that as well. So
Yeah.
one thing that I didn't mention was development finance lending. Of course, there's an awful lot of homes being built around the country. Talk to me a little bit about development finance and what's going on in that regard.
Yeah, and it's an exciting opportunity because it's not just a parcel of land that has an opportunity to be built on. It may be that there's an existing operator that has substantial amount of land attached to it, and actually that could be stripped out, and whether there's an extension or it is a new build development, that there is lots of opportunities. And if we look at that as an example, we've worked with several operators where we're looking at stripping the title out, because ultimately the bank security is based on the serviceability, which I've alluded to, and the bricks and mortar. They're not really ascertaining any value necessary from the grass that's the land that's attached to the building or to the site. So from that position, we work with several operators to say, well, let's strip that out, and now you've got an unencumbered parcel of land that we can develop on. If we look at the bandwidth between the lenders, that they are quite similar in terms of what they're looking to achieve, which is very creative lending, very holistic in their approach, which is it's not going to be on the serviceability because there isn't any on day one. So it will be a method of rolling up the interest, rolling up the payments. That the key for them at that point is the track record. So have they done this kind of thing before? And if not, what's the credibility, the quality of the management team they're going to be using? And that really will be their key driver, along with the exit. And that's crucial for them, because ultimately they're saying, we're going to lend you this money. We're not going to put any pressure on you right now to pay for it. So we need to make sure that we have an exit plan that is credible. And that should be through, the likes of, a challenger lender / high street lender, who at that point will be able to look at not a piece of grass, but they'll be able to look at a nice purpose-built facility, which fits within their policy now.
And am I right in saying, so typically a lot of the time that you'd have one lender to provide the development finance, and that typically that they would get refinanced out at a point of maturation where the home was full enough to be able to refinance, where you've got that serviceability?
Yeah, I think it's a really good question, because it goes back to that point where there isn't really a lender that can offer you that full. There are, but unless you've got the track record, there isn't necessarily a lender that has the ability or the intention to look at that full bandwidth from piece of grass, parcel of land, to maturity of a building. So the old school would be two lenders. You would probably look at a developer that can build it, and then high street challenger lender that will then take it out at, as you say, maturity. The interesting thing is, we've worked with several, but one client in particular who was actually a developer, and we were working with them to look at a different option. And the option they weren't aware of was they were having to put down a considerable amount of money per each development, and they were only getting that back, or the opportunity to utilize the value at maturity. Now we can look at lenders, and there are lenders in the market that will look at on PC, so when it's built. Now that changes the game slightly. Sorry, Simon.
No, just to double check and make sure that I'm not misunderstanding. So PC, we're talking practical completion, is that right?
Correct. Yeah. So apologies. Yeah. So at the point of when it's built, at turnkey, you can open the door and you have a shell and it's built. There's also an opportunity now to actually look at a lender to do the refinance at that point. Now for them, the advantage was they were able to remove the bridging or development funding, which was relatively expensive, put that onto debt, which was cheaper. But most importantly, not necessarily the rate. The important part of this was the amortization, because bridging is and development money is only short term, because that's the build. once you can start amortizing that over 15, 20 years, that from a cash position, then it makes an enormous difference. So they're able to realize some of the profits and then redistribute that into another project. But the other thing is, they're realizing that because to maturity, it might take 18 months. So they're doing it 18 months early. So it's almost, from a 2-phase, it's potentially it's now become a 3-phase. And that would be used, that proposal was looking at 3 separate lenders for that, which is a really interesting model. But it shows you, and that's as I say, they're a developer, so they're aware of existing lenders. But it was something that was really interesting case study, and I think we will see more of that moving forward.
And I guess so you've got the realization of the value of the property that you're building, but I guess if you've got a relatively aggressive opening targets and things, you're opening lots of homes in relative quick succession, knowing that homes that are further back in the development pipeline, because effectively that money is going to get redistributed into reinvestment somewhere along the lines, aren't they? And it's probably going to look, if people do have an aggressive time opening schedule, if you like, that money can be better used elsewhere with the right level of finance.
Yeah, absolutely. To hit around figures, they were putting in say if it was 8 million, then they were putting in 4 million. Then it went from only having to put 25% in, half of that, and then realizing that. So what they were saying is, rather than having to wait 18 months post PC, practical completion, they were getting that early, but then not having to put as much in and then moving quickly as well. So that, what they were saying is we can double the workflow, which is really interesting.
Mm-hmm. No, that's super helpful. Thank you for explaining. And a lot of providers will be interested in the redevelopment of their current assets to enhance the home in whatever way that might look like. How do banks feel about supporting in that kind of respect? Maybe an extension, maybe a change of use, maybe some refurb, that type of work. Typically, what are you seeing from banks in that respect?
Yeah, and I think that's it's a good question, because a lot of homes will have, especially sort of if you look at the converted stock, there will be the opportunities to enhance it, to refurbish it, extend on it, as we've discussed. The banks are open to that, because ultimately, they will say, it's improving, enhancing their security. So I would say resoundingly, it would say yes, that's a positive, because the caliber of their security is enhancing. The trade-off is how much it's going to cost. Do they have the skill to do that, depending on the level? Is this just a light refurb or is it a full extension? But the other element would be, is this going to impact on trade as well? So, if this is a great idea and the end result is going to be very good, but actually, they're going to have to shut half of the home for 6 months, then there's going to have to be a rigid plan in terms of, do they have savings or plan B to support the lack of serviceability? So that will be the trade-off for the bank.
Right. I guess they're always going to get excited if they think there's opportunity to safely lend more money into an asset, into a business that's going to be comfortably able to repay that loan, particularly if it's going to add extra beds or maybe reconfiguration to have larger rooms or kind of rooms that are particularly focused on the private end of the market.
Yeah, absolutely. And then also you've got to look logistically, does it make sense? Are you enhancing a home where, you're already maybe at the ceiling of what weekly fees are going to be? Or does it make sense? If you look at comparable information, actually, will this change, enhance performance, with profitability within the home? So I think you've got to look at all the sort of components of that. But a whistle stop answer, yes, the bank would be definitely supportive on principle of doing that, just as long as we can make it work.
Got you. Okay, lovely. Metrics. Talk to me about the type of metrics that banks are currently using when it comes to all types of different lending, and I guess put them into context and just explain a little bit about each point, just so that the audience member can get a real appreciation for exactly what the banks are going to be looking for when it comes to lending money.
Yeah, absolutely. So the, certainly the most important traditionally component of the lending process would be the loan to value. So that is purely just, the value of the home versus the debt that's outstanding. That, as I say, is the old school way of, and always the most important component in terms of a credit policy. But that has been, I wouldn't say been relegated, but there are other components now which make up that decision. And one that I would say that's even more important now is post 2008, really is the serviceability, which is derived from financial performance from the accounts. So that is the lever worked out on a leverage calculation. So a leverage calculation is a multiple of EBITDA into the proposed debt quantum. Now that above all is, I would say, in my opinion, is the number one measure for a debt facility. We also have then, the CQC, the quality of the rating within the home, fundamentally, extremely important. I think depend on the lender. There is a bandwidth in terms of their approach. There can be, movement within that. We all are aware that there are a lot of homes which are RI, which simply aren't. There's plans in place, and that's another conversation in terms of the getting the upgrade on there. But if the majority of the homes, is good, or the group is good, then yeah, that's a positive. And then the last point alongside, the management and the CQC is the type of home. And I would say that we've seen possibly, a two-tier model, if you like, within the sector. And that's been formed, if you like, from this emergence of purpose-built new facilities. Lending is driven now, and the bank's appetite is driven for purpose-built 60-bed plus facilities, and everyone is aware of that. And that's what the banks are looking for. Even some of the challenger banks are now showing, motivation to move towards that kind of lending. The issue that we see with that is you're seeing multiples because of the exit. You're seeing multiples that are going up within, say, down south of as much as 10 to 12 times, which is in line with, say, hotels. It's within line within hospitality. But that isn't across the board, and it leads on to the other part, which is the converted stock, typically sub 40 beds. Now, that has a ceiling in terms of what multiple that's going to achieve, but there's still that there is certainly a home for it, and there may be people that are saying that the future of care is moving towards that purpose-built model, but I think there will always be this demand for a more boutique facility, home from home environment, which you get from sub 40 bed facility. And when you look at that, I have had conversations with people say, well, is this model sustainable? But I think what's interesting about this, if you look at the way that it's being valued, a converted Victorian building or extended care home may have a ceiling of a multiple, a profit of, say, 7.5 times. That's only going to be valued or acquired really from an owner occupied regional operator. But if you look at a lot of the stock that we're seeing, purpose-built facilities, it's being acquired by, as you're aware, pension funds and REITs, and they're valuing this stock on a different metrics to do with yields, etc. And their return supports this higher multiple. So when we look at, is this sustainable? The interesting thing is, I actually think it is. So my point of view would be from the asset class, there will be a ripple effect where, if you're buying something that's 10 times and you've got something that's smaller but just as profitable, I think there will be the ripple that will go up. So I think it's an interesting time for the sector, but certainly a positive.
quick note about one of the sponsors that makes the Care Leaders Network podcast possible. Compass Associates works in partnership with the care sector by supporting care providers with their recruitment and retention needs. They've won a number of industry awards over the years and specialise in placing mid to senior roles in the elderly care sector. Compass have offices in Portsmouth and Manchester, but deliver their services nationwide. And to find out more, head to www.compassltd.co.uk. Got you. Thank you. A couple of things I just wanted to dissect there. I think you've played out the landscape for this specific question really, really well. I just wanted to double check. So when you're talking about loan to value, that's almost like when somebody buys a house, it's 15% loan to value. So that's pretty straightforward. When we're talking about leverage and multiple profit, am I right in saying that this is why the EBITDA profitability, the calculation around that is so important, because it's the best way to be able to give a clear indication around serviceability and free cash flow within the business?
Yeah, so from your question, I probably can just go straight onto it. But yeah, if you look at the EBITDA calculation is absolutely paramount. It's looking at the net profit, with adjustments made to it, and which is sustainable for the business moving forward for that accounting period. And it's then the leverage is a multiple of that figure. And then that will then go to support, the loan to value, etc.
Sure. I'll ask you a question about credit policies in a minute, but we'll come on to that in a second. The next point that you raised was just around the CQC. I guess an awful lot of operators and providers are going to be in this really frustrating set of circumstances where maybe they've either bought an asset that's come with that requires improvement or worse, or maybe they've just been unlucky with an inspection, or maybe it's been a very realistic inspection, but they've done the work to overcome the shortcomings to get it back to a good. I can imagine there must be so many people who the credit committee isn't interested in doing the deal until the CQC's come back and re-inspected. But the CQC at the moment, obviously they seem to be in a certain amount of disarray. Most people probably will have been aware of the fact that apparently, I can't remember the number now, but more than 50% of the CQC's workforce have voted to strike at some point in the not too distant future, which I can't imagine is going to speed things up. I can see that being something that both lenders and operators and providers are going to be sat there thinking to themselves, I wish all of this would just kind of hurry itself along. But I guess that's kind of in the lap of the CQC gods at the moment, because there's quite a lot of tension, I'd say, relevant to the regulator at the moment.
And I don't think they necessarily appreciate the impact that can have on the operator. That could be the difference between that could be the difference between you could be in breach within an RI of your covenants. That could then have ramifications on triggering a valuation to be taken place, and that might be for the whole of the group. That's a considerable amount of money. Or it may be on terms of due diligence. There might need to be mock CQC plans attached. It can have an impact on every level within the appetite. It may just be that the bank will refuse to actually do the lend because of the grade. And I think, on the positive, I think if you do have, and I do think it's a great opportunity in the market for regional operators, if you do have that appetite for growth, looking at if you have the track record and brand and quality of care in-house, then it lends itself to looking at homes which are underperforming, which don't have that. And that's where, as we say, you can really, within the market, there's opportunities to acquire, homes at discounted rates for whatever reason. And then, imprinting your brand into that home will potentially end in a sizable profit.
Yeah, lots of value growth in that respect as well, which of course is going to be super helpful. Obviously buying at the right level is really, really key. And I guess this kind of links back to the last point that you made around asset types. The fact that you've stated that you see almost like a two-tier system in the care sector, I think is I guess it's not a surprise, as you say, you've got these kind of two different types of, you've got the more traditional stock, which is 7.5 times multiple. And then you've got the kind of purpose-built, brand new, quite fancy, typically in, again, you mentioned the kind of the southeastern things like that. And you've got this massive range of 7 to 12 times multiples, but those models apply to very, very different businesses. I bet this is a story that you hear all the time in kind of different guises, but I was chatting to somebody the other day who was basically, they'd had their expectations mismanaged by an agent. They'd got a great kind of humble kind of 25-year-old home, which performing in really, really well in lots of different ways. But they put it on the market, and the agent had told them that they thought that it was probably somewhere into double figures from an exit value perspective, and they waited and they waited and they waited. And I guess it's almost like the two different tiers. The let's call them the tier one category has been applied to the valuation of a tier two asset, and obviously the person selling the business wasn't particularly happy about the set. So they've now gone through the process of finding a new agent and stuff like that, and it seems like it's going in the right direction. But I know obviously you've got, in your business, you've got the finance side of things, and then obviously you've got Anthony, who's working on the brokerage side of things. Again, I'm imagining that this is a story that you hear time and time again, where expectations have been mismanaged around multiples and all of that type of stuff.
So yeah, absolutely. And Anthony's doing a fantastic job, and what we're looking to achieve is really a boutique option and service for our clients, which is truly client centric, which is we can source opportunities and finance them in a holistic way. We're not looking at transactions, and I think that's what there is a demand for that. There's a demand for operators who are wanting, as we said, there isn't really, when you look at the old school bank manager of old, there isn't necessarily that opportunity to speak to someone who's going to be there for the next 15, 20 years throughout your journey. And that's we have the track record and experience, and that's what we're trying to apply. But going back to that example you said, yeah, I know of a lot of people that will be in a similar scenario, which is the name of the game is winning the instruction and getting it on the market, and worrying about what the listing or the multiple is later. And you can only get away with that so many times, because it is a small sector. We all talk, and it just won't last that long. That mentality. So yeah, I think the positive within those examples is, I think there will be a ripple effect where we see, if you like, the tier two will naturally increase in value because of the performance and prerequisite, which is the quality of care.
Of course, that makes a lot of sense. We touched upon this earlier, but I want to just get into this a little bit more. So, banked credit policies. Talk to me about what they're looking like at the moment in the new post-COVID world.
Yeah, absolutely. So I think if we look at refinance and acquisition for an existing operator, as a case study, I think the loan to value that you're likely to see will be around 60 to 70%. I think for rates, there is a bandwidth there in terms of whether it's high street or whether it's challenger, but it will be sub 5.5%. Now that's range to say 2% to 5.5%, so it's a big bandwidth, and that will depend on the loan to value that is applied to that deal, and then, as we said before about the leverage calculation is so important. And what we're seeing in the market is between 4 and 6 times. So again, that's 4 to 6 times EBITDA. And that's the interesting thing, because you could have a loan to value at say 70%, which sounds great, but then if the leverage at 6 times, and this is getting that figure correct, that might bring it back down. Or the other way around, it might be that there's a really well performing home that's doing fantastic and actually it's making a lot of money, but the loan to value brings it down. But broadly speaking, they should be in alignment of say 60, 65, 70% should broadly speaking be around say 5 times leverage. The other thing, just to confirm as well, if you like, is on the loan to value, there are different metrics to how you may calculate that figure, depending on the lender. So the way that you would look at the loan to value of sort of the trading performance of the home, that's the bricks and mortar and the trading performance of the home is the MV1. So that's ideally what we're looking for. If when you're looking at, realizing the top level, you're wanting a lender that will not just look at the bricks and mortar of the facility, but also will encompass the trading element of the home. Whereas some lenders towards the lower end of kind of challenger and bridging will only look at the bricks and mortar. So say 60, 70%, but only of the bricks and mortar value.
A quick word about one of the sponsors who helps make the Care Leaders Network podcast possible. Bevan Britton works in partnership with the social care sector, delivering high quality legal and regulatory advice. Their award-winning teams across the UK provide workforce, regulatory, corporate, commercial, real estate and litigation advice, and their team truly believes in strong partnerships. They really understand what it takes to deliver outstanding care and to build a thriving business. To find out more, head to bevanbritton.com.
Does that make sense?
Yeah, no, totally. That makes absolute sense. Okay, great. And then I guess talk to me a little bit about the CQC, because I guess that's going to be a factor within all of this. I know that you kind of touched upon this, but have I understood it right that so if you've got a good portfolio and you're buying a home that maybe isn't maybe a good, maybe it requires improvement or even maybe inadequate, I'd be interested in that as well. If you've got a good portfolio and maybe a subpar target, that's something that is that's kind of open to consideration. But maybe if you don't have such a solid portfolio, if you're then looking at buying more challenged homes, let's say, that's where you're likely to come into more resistance around successfully getting lending approval for those types of deals.
Yeah, I absolutely agree. Yeah, it's not, if you have the track record and experience, then you can look at opportunities where the level of CQC is underperforming. But broadly speaking, if it's a refinance, you'll be judged on the quality of the level of care within your group. And yeah, the blended percentage needs to be the majority rated at a good level.
Sure. Yeah, that makes sense. And I guess the last thing that I'd be really, really interested to hear from you. So obviously we're coming off the back of a few years of pretty tough trading conditions. How does the financial sector go about evaluating a good investment in the care sector?
Yeah, I think it's a really good question. There's a lot of uncertainty. You don't have, I don't think any business just has now 3 years of accounts which are, in line, perfect. But everyone has been impacted. So that, the way that you analyze that, review that, requires a bit of attention. If we look at it in terms of an owner-occupied trading business, then there are a couple of things that may have happened. There may have been an impact reduction in occupancy in trade. There may have been COVID grants applied, and we've seen that a lot. The way that is manufactured in terms of valuation, there are some businesses that have actually received a spike in performance, i.e. trade has remained, but actually with the COVID grant that's been applied, there's been a spike in performance. Now, in those situations, the banks are likely to remove any COVID funding that's been applied. If it's a case where occupancy was affected, trade has been impacted, then actually, and there's COVID grants that have been applied, then there's every chance that the banks will look at that favorably and say that should be in line. It's about a level of fairness. It should be a holistic approach, which is fair to the home and to the operation. That can be further supported by evaluation, and the term that will be used is an FMT. So that's a fair maintainable trade. And that is fundamentally pivotal because that is a projection-based indicator. So that will say, moving forward, based on what we've seen, this is what should be happening. So if we go 17, 18, was great, in line with where we thought it was going, and then 1920 was impacted heavily, and then we're starting to see, recovery, shoots of recovery, and now it's doing well. What we should then be looking at is a fair, maintainable trade, that, as if that wasn't, that didn't happen, or that the grant was applied, and actually we can take a view, and that projection-based indicator will then provide a number, an EBITDA number, which can then be used as the multiple.
Yeah, definitely. And with the FMT, with the fair maintainable trade figure, does that calculation come about through the trading performance of that particular business, or is that almost like an aggregated view of what other similar businesses?
No, it's a good question, and no, that should be associated with that home. And as I say, it can work both ways. It could be, that the occupancy has been impacted, as we said, and performance, should be in line with what it was doing pre-COVID. Then that figure will likely be higher than what it's doing, and that could be used for the purpose of the bank to say, well, rather than work out serviceability based on, the impacted performance, let's use the FMT figure. That's a fair representation of where the business is going, and that's a better guide. But actually, it can work the other way, where you may have a home that has a truly unique management team in situ, and let's say it's a disposal, a client is looking to acquire that, and actually, that management team is going to be leaving the building, and occupancy is 100%, it's doing very well, it's almost classed as overtrading, if you like. Then there may actually be a reduction in that FMT calculation, because they may actually apply a fair representation to say it's not likely, or it's not fair for someone to expect to just hit the ground running at that level. Actually, we think it may be, let's apply a rule of what we're seeing in the market, which is 85 to 90%, rather than 100% occupancy. And actually, the trade would be reduced slightly, or the EBITDA calculator would be reduced slightly. So it can work both ways, but certainly the most important and most commonly used is the first, which is, is to support homes that have been impacted. And that figure will be a fair representation of where the business is going.
Makes a lot of sense. Thank you, Scott. We got together to talk about what was going on in debt financing in 2023, and I feel like we've covered off just about all of the bases we possibly could do. So I guess anyone that's interested in exploring this subject in more detail, obviously you're available on the Care Leaders Network, so feel free to give Scott a buzz at any point if there's things you want to elaborate on. But great to have the conversation with you. Thank you so much for your time.
Thank you very much, Simon. Fantastic.